Hello, good morning. Welcome to the session, my dear students. So, as we have already discussed basic problems on hire purchase system in the previous sessions, in today's session let us see the next adjustment with hire purchase system, that is the most important adjustment, that is when the cash price is not given in the question, how do we calculate the cash price of an asset or an machinery. In the previous sessions we have already seen when the rate of interest is not given what can be done, how the calculation of rate of interest amount has to be done. But in today's session they have already given us installment amounts, they have given us rate of interest also, but the most important thing is the cash price of an asset or cash price of a machinery that an hire vendor will be selling off. So, that amount will not be given in the question. At such cases or with such instances, how do we calculate the cash price of an asset becomes an important adjustment here. So, this is how the question goes on. The question starts from calculate cash price from the following. So, the first statement itself they are directly asking you to calculate the cash price from the following given details. So, here the first detail that they have given is rupees 3000 paid at the time of agreement. So, during the agreement of this hire purchase, they have given 3000 is being received. So, this is the down payment amount on the time of agreement. Moving on to the next statement, that is rupees 21,600 is being paid during the first year. So, it is very clearly mentioned the first year installment is paid in the value of 21,600. Moving on to the next statement, 20,700 is being paid during the second year. It is very clear they are not directly telling you that these are the installment amounts, but they are telling this is paid in the first year, this amount is paid in the second year. Moving on to the third one, that is rupees 19,800 is being paid in the third year. Again, this is the third installment given in the question. The last important statement is rupees 18,900 paid during the fourth year. This is the fourth installment amount that they have given. The last extra adjustment that they have given is rate of interest will be 5% per annum. So, if you are giving an installment for minimum 4 years, the rate of interest that you are charging to the hire purchaser is 5% per annum. For 1 year he has to pay 5% interest on all these installment values. The next last one is depreciation will be paid or depreciation will be applied on this machinery or an asset at 25% per annum. 1 year the rate of depreciation that you are charging on the asset that you have purchased will be 25% for 1 year. Under which method, as we all know, we have several methods to calculate depreciation. Here they have clearly mentioned use straight line method. This is a small simple method where first year if you calculate a depreciation, the same value or the same depreciation amount will be carried forward for the further years without making any more adjustments. So, this is the analysis of the question. Moving on to the analysis table or the solution. So, this is a small table that you have to follow to calculate cash price of an asset. So, here this is how the table goes on. You will have minimum 7 columns here. You will have minimum 7 columns. Out of these columns, first column will be for date, the second column is for particulars, third one is for the installments, third column is calculation of interest. This particular column can be taken as working note also, or you can put it inside the table itself. The next column will be interest, the next one is principal amount, the next one is depreciation. So, overall if you see the question picture, it is very clear installment is inclusive of interest. We have to apply this 5% and remove the interest from the installment values and find out the principal amount. This is how the introduction of analysis table goes. So, let us start from the years. So, years, as we have already mentioned, we have 4 years, that is installment. They have clearly mentioned we have 4-year installments. So, you have to come to the conclusion that the agreement of this hire purchase goes for minimum 4 years. So, take the years, first year, second year and third year and fourth year. So, after years, the next column will be for particulars. First year when you are considering First take the down payment value. Write the down payment here. Installment, in the installment column you can also consider this as down payment installment. When it comes to interest, to the down payment value we will not calculate any amount of interest. So here keep it nil, and interest again keep it nil because we don't calculate any interest on the down payment because you will be paying instantly on the date of agreement. The same value will be taken in the principal amount column, and depreciation will not be charged on the down payment value. So this is the first data that you have to enter in the table. After entering this much, there is one small change that we do when we calculate cash price. That is, generally what we do is first year, second year, third year and fourth year. This is how we start calculating, but when it comes to cash price we go vice versa. We will start from fourth year, then third year, second year and coming to the first year. After entering the down payment value, anyhow you will be taking all the years. Now let's start from the fourth year. Yes, fourth year the installment value that they have given is 18,900 as given in the question. 18,900 is the fourth installment value. On this they are clearly mentioning apply 5% interest. Interest is always rate of interest divided by 100 plus rate of interest. So what we are doing is we are taking the fourth installment into 5% rate of interest. When you multiply, you are getting a value of 900 rupees. So the actual installment is 18,900, interest is 900. If you remove this 900 from 18,900, you are amounting to 18,000 principal value. So the pure principal amount that you are paying in the fourth year is 18,000. So this is the first year calculation we have done. Moving on to the third year now. Third year installment, they have clearly mentioned it is 19,800. For this 19,800, we have to calculate interest value now. To calculate that interest value, one small calculation or the addition that we have to do is, you will have to consider or you will have to find out an outstanding balance of the cash price. For that what we do is, 19,800 is the third year installment. To this we will take the fourth year principal value. So this 18,000 is the balance, outstanding balance of the fourth year. Consider that balance and add it to the third year installment. When you add together, you will be arriving at some value. Then multiply that with 5% rate of interest. You will be amounting to 1,800 rupees interest. So you can check out here, 19,800 is the total installment in the third year, out of which you are getting an interest of 1,800. If you remove 1,800 from 19,800, you are amounting to principal value of 18,000. This is how we calculated for third year. Moving on further with the same process to the second year. Second year the value is 20,700. This is the, it has already been given, we have not calculated or we have not adjusted. This installment is directly given in the question. 20,700 is the second year installment that they have given. So 20,700 plus the outstanding principal values. Till here you have already calculated 2 years principal value. So this becomes the outstanding balance. So take these two outstanding balances, that is 18,000 and 18,000. So you will be adding 18 plus 18 to the second year installment and multiply it with 5% rate of interest. You will be amounting to 2,700 rupees. That is the interest amount. So 20,700 minus 2,700, again you are arriving at 18,000 principal value. So this is the calculation that happens each year. One small clarity that you should have is, every year when you find out principal balances, principal amount balance, consider this principal balance while calculating the interest. Moving on to the first year installment, they have given us 21,600 rupees as given in the question. So let's take this 21,600, then add the outstanding balances of last 3 years, that is fourth year, third year and second year. You have 3 principal values here. So 18,000, 18,000 and 18,000. So 3 times 18,000 plus 21,600 first installment into 5% rate of interest, you are arriving with the value of 3,600. 600 rupees. So from 21,600 rupees, if you remove 3,600 rupees, you are amounting to principal value of 18,000. So this is how we got the principal value for all the years. Calculation of interest also is done. So this is how the calculation of interest will be calculated, and the principal values will also be done. The last part of this problem is now we have to calculate the cash price of an asset, and then coming to the last adjustment, that is depreciation has to be applied on the asset value. We all know that depreciation or the rate of depreciation should always be charged on the value of an asset or value of a machinery. So here first we have to find out the value or a cash price of an asset, then from that we have to calculate the depreciation rate of 25% with straight line method. So after all these principal values done, what we have to do is we have to take the total of all this principal column. 3,000 is the down payment in the first year. Along with that, these are the 4 principal values for different 4 years. So when you total it, you will be arriving at 75,000 total. So this 75,000 will become the cash price of an asset or cash price of a machinery. This is how we find out a cash price if in case it is not given in the question. Generally it has to be given, but this particular adjustment is it will not be given. You have to follow this process and find out the cash price of an asset. Now cash price we have done, we have got the solution. Now the next last adjustment is depreciation. This depreciation, in case if it is given in the question, it is better to show the calculation, but when it comes to journal entries, we will be showing it in the journal entries later. So how to calculate the depreciation values is, we have 75,000 value of a machine. So 75,000 into 25%. Directly when you apply, you will be getting 18,750 for the first year. This is the depreciation value on the cash price. 75,000 is the value of the machine. 75,000 into 25% depreciation will be amounting to 18,750 in the first year. So this is first year, but here they have made it very clear we are using straight line method of depreciation. This method is nothing but first year depreciation value will be carried forward for all the years. We will not do any kind of adjustments here. First year whatever value we get on the rate of depreciation, the same value will be taken and carried forward for all the years until the agreement is done. So likewise, first year we have got 18,750, second year also will be carrying forward as 18,750, third year also 18,750, fourth year also 18,750. This is how we calculate depreciation also if given in a question. So overall, this is how a cash price of an asset or cash price of a machinery, if not given in the question, will be calculated. Thank you students, thank you for the session.